In this episode, I'm going to show you how it's possible to double your money with dividend stocks. In fact, we're going to look at some examples where you can more than double your money with dividend stocks. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. We're going to look at how you can double your money with dividend stocks, but we're going to be doing it safely and reliably. We're going to look at how you can build a resilient dividend stock portfolio, regardless of what happens to stock prices and regardless of what happens in the stock market. So let's get started. We're going to be looking at 6 different topics in this episode. Topic number 1, dividends are key. So we're going to look at that first. Then we're going to look at investing in profitable companies. Then we're going to look at investing in market leaders. Next, we're going to look at dividend growth companies. And after that, we're going to look at the benefits of holding for the rising dividend. And finally, I'm going to show you some real life examples where we've taken some stocks and over time, we're able to more than double our investment. Let's get started with topic number 1, dividends are key. Most important here is you want to invest in companies that pay dividends. And what is a dividend? A dividend is simply the company sharing its profits with you, the shareholder. Let's take a look at a real life example here with a Canadian company, Fortis. This is a company that operates as an electric and gas utility company in Canada, the United States, and in the Caribbean. The company was founded in 1885. They have over 9,000 employees, and currently the market cap is over $26 billion. Now, this company has a current annual dividend of $2.26 per share. So let's say you own 1,000 shares in this company. We multiply that by $2.26, which is our dividend. You will receive every year, for as long as you own these shares, and as long as the company continues to pay the dividend, you will receive every year $2,260 in dividends each year. Now, hopefully that's going to go up every year. The company has a history of increasing its dividends. But for now, just looking at this year alone, the annual dividend per share, like I said, was $2.26. So we multiply that by the 1,000 shares, and you will receive $2,260 in dividends each year. Now, important to note here, the stock price can go up, the stock price can go down. But as long as you own those 1,000 shares, you are going to get $2,260 in dividends each year. Now, this money is deposited, the dividends are deposited directly into your stock trading account as cash. So you can spend the money if you wish, or you can reinvest it. And as a dividend investor, we want to reinvest it into other stocks that are paying us dividends. And that way we can grow our portfolio. Now, let's take a look at this stock chart up on the screen here. This is Fortis, and we are looking at its stock price and its dividends since 2007. So you can see on the screen here, stock price goes up and down. What's important to us here is the orange line. The orange line here represents the dividend. And you can see that the orange line has gone up every single year since 2007. In fact, this company has a history of growing its dividend consecutively every year for 49 years. Now, let's move on to our topic number 2, investing in profitable companies. So I'm going to go back to the chart that we just looked at for Fortis. So again, we can see the stock price going up and down. We can see the dividend has gone up every year. In this stock chart, we're only going back to 2007. But if you look at the stock price, that's your blue or purple line, you can see that in some places, the stock price drops by $5, drops by $10, drops by $15 in the stock price. So those are big drops, 5, 10, 15. And you can see the stock price goes up and down, up and down. And we see on the screen here, you can see significant drops in this stock price. So then you might be wondering, how can a company continue to pay a dividend? How can they continue to increase the dividend every year when their stock price is tanking? And the reason is dividends are not paid from the stock price. Dividends are paid from the earnings. So what we need to do is we need to look at the earnings for this company. So again, we're looking at the stock chart from 2007. And so you can see the stock price going up and down. But now we've changed something here on the screen. Now we're looking at the earnings per share, which is essentially the earnings, the profits of how much money the company is making every single year. So now the orange line represents earnings per share. And we can see there's one drop at around 2015. We have another drop in 2017, and then we have another drop in 2021. So the earnings did drop 3 times since 2007. That's not a cause for concern immediately. What we want to look at as long-term investors, and I've been doing this for over 23 years, as long-term investors, we want to see the earnings going up. We want to see the trend going up. Company may have 1 or 2 or 3 drops in a 15, 20-year period, but as long as the earnings are growing and increasing, that's what we want to see. So that's why I wanted to share this example with you with Fortis. Even though there has been 3 drops in the earnings, overall, the trend since 2007 is that the earnings are growing. So now let's take a look at 2 examples. I'm going to give you 2 examples up on the screen. And the question I want you to answer is, which one of these companies would you invest in? So I'm going to look at the 15-year history of earnings per share. So how profitable has the company been over the last 15 years? So we're going to look at 2 companies. We'll start with United Health Group first. So up on the screen here, you can see the earnings have gone up consistently. In the last 15 years, we see the line is going up. It's a nice slope, and it's just going up every single year. So that's good. Now let's take a look at our second company, Nokia. What do the earnings look like? So now here we see the earnings they drop, then they go up a bit, then they drop again, then they go up again, then they drop again, drop some more, go up a little bit, and then drop again. And so what we're seeing is sort of a jagged line just going up and down, up and down, up and down. When I look at these 2 companies, Nokia doesn't give me any confidence. What's going to happen in the next 5 years, 10 years, 15, 20 years down the road? Is the company going to be profitable? Are the earnings going to go up, or are they going to go down? So if I look at Nokia's graph, I have no confidence. I don't know what's going to happen. It's completely random. It just goes up and down, up and down. When I look at United Health Group, I see a nice slope. The line is going up consistently. So I can have a high degree of confidence that their earnings are going to grow. Now, no one can predict the future. Nobody knows what's going to happen. I don't know what's going to happen in the stock market next week, next month, or next year. But when we look at these 2 graphs, we have a higher level of confidence when we're looking at United Health Group that the earnings are going to go up. So the question was, which company would you invest in? Well, all things considered equal, so we're going to assume the debt is the same, everything else is the same. All things considered equal, United Health Group would be the one you would look at. And Nokia is the company that you would skip for now and just move on to something else. Now, in the Simply Investing platform, and I'll talk about it briefly at the end of this video, but in the Simply Investing platform, there's 2 things that we really look at here. So we look at the 20-year average EPS growth, and you can see I've put some examples of companies up on the screen. All things considered equal, the higher the earnings growth, the better. So the company at the top of the list has a 20-year average earnings growth of more than 74%, versus if you were looking at a company that had an average EPS growth of 2%, 74% is a lot higher than 2, So again, all things considered equal, the higher the average growth, the better for us. The other thing we look at is the number of EPS increases in the last 20 years. So again, the higher the number, the better for us. So remember, higher earnings is going to equal, over the long term, higher dividends. So that's going to put more money in your pocket. It's the dividend income that's important for us and not the stock price. Next, we want to invest in market leaders. Why? Why do we want to do that? Because I'm going to go back to what I said in the beginning. We want to build a stock portfolio, a dividend portfolio, safely and reliably. We don't want to put our money at risk. We want to make sure that our portfolio is generating dividend income and it's growing that income reliably year after year after year. So it's important that we invest in companies that are leaders in their industry. Why? Because industry leaders are well established, they have majority market share, they have a large customer base, they have excellent customer loyalty, and they make it very difficult for competitors to challenge them. So these are the types of companies that are going to be around for a very long time, and they're going to grow their earnings, which means they're going to grow their dividends. So let's take a look at just a couple of examples. If you brushed your teeth this morning, most likely you used one of these products. So up on the screen, we have some logos here. We've got Colgate, Crest, Sensodyne, Tom's Toothpaste. I know there's a lot of other toothpaste brands out there, but these are some of the big ones, and you may recognize them. Even if you don't use them, you may recognize some of these logos that are up on the screen. So these are really companies that are market leaders in their industry. Another example is Coca-Cola. Everybody has seen this brand. Everybody knows what this company does and how this company generates revenue. Coca-Cola was founded in 1886. They have over 79,000 employees, and their products are sold in over 200 countries. Now, there's a lot of text up on the screen here at the bottom. These are some of the brand names that are sold under the Coca-Cola umbrella. So you'll recognize Diet Coke, there's Coca-Cola Light, Coca-Cola Zero, there's Powerade, we have Dasani, Vitamin Water, Smart Water, Minute Maid, and there's a whole other bunch of brands you can see up on the screen. And this company is a market leader in its industry. If you were to start a beverage company today to compete with Coca-Cola, you would have to spend billions and billions of dollars in marketing and advertising and product development, and you still wouldn't get to where they are today. It would take you decades and decades and decades, and I don't know if you would ever get there. So this is a great example of a company that makes it difficult for competitors to enter its space, and it has brand recognition and brand loyalty. And what does all that mean for us as dividend investors? Well, this is a company that has been paying a dividend since 1893. So I'm going to say that again. This is a company that has been paying a dividend since 1893. And more importantly for us as dividend investors, they have consecutively increased their dividend every single year for 60 years. Okay, let's close off this section here. The most important lesson here is that you want to invest in companies that are market leaders. Okay, now we're going to take a look at our next section, which is investing in dividend growth companies. And why would you want to do that? Well, number one, you want to get paid dividends. So, like I said, it's money gets deposited directly into your trading account. You can spend the money if you wish, or you can reinvest it. So you do want to get paid. Number two, you want the dividends to grow every year. Why? Because that's going to put more money in your pocket. And this all comes back down to this statement, the equation that you see on the screen here, which is called real total return. And so your real total return for any investment is going to be your capital appreciation plus dividend income plus dividend growth. And you can see that the dividend income and the dividend growth is a large portion of this equation. And that's why we spend so much time and focus on dividends. Now, here's some examples of companies in the US. Some of these companies have been paying dividends since the 1800s. We see Colgate-Palmolive, 1895, up on the screen. Coca-Cola, which we already talked about, was 1893. Procter & Gamble, 1890. So they've been paying dividends for a very long time. More important to us as dividend investors is that these companies have been consecutively increasing dividends for more than 50 years, 55 years, 65 years. And you can see all of the numbers up on the screen. Think about how many recessions and market crashes we've had in the last 50 years. But yet companies like these have continued to grow their dividend year after year after year after year. One more slide. This is in Canada. So again, we have some companies on the list that have been paying dividends since the 1800s. And again, we have companies that have been consecutively increasing dividends for more than 20 years, 25 years, 30, 45, 50 years. Now, our next topic is the importance of holding for the rising dividend. So you want to hold on to the shares that you've bought because of the rising dividend. So let's take a look at a real-life example with CIBC. This is a large Canadian bank. Now, let's assume in this example, in 2010, you purchased 300 shares. Now, the share price back then was $31.95. So we multiply that by 300 shares, and your total investment in this company would have been $9,585. Now, in 2010, the company was paying a dividend of $1.74. Now, if you recall, our dividend yield is basically the dividend divided by your purchase price. So the dividend is $1.74. We divide it by $31.95, and we want to express that as a percentage, and you can see that it is 5.45%. That is the return on your investment while you hold on to the shares. Again, the share price can go up and down, but in this example, as long as you held on to the 300 shares and the company is paying a dividend, in this case $1.74, your return for that first year would have been 5.45%. And you can see that as a dollar amount, which is $522 in dividends in the first year. So that's not bad. The company has increased its dividend every single year since then. The dividend today is $3.32. So we take the current dividend divided by the purchase price, which was $31.95, and you can see that your return on investment is 10.39%. So a little over 10%, which is fantastic. You can't get that rate of return in any bank account, checking account, high interest savings account, in a term deposit, or even in a bond. And so in this example, you would now be earning over 10% every single year just for owning those shares. And so you can see that the total dividends received since 2010 is $9,258 in dividends. And remember, your initial investment was $9,585. And by the end of this year, as of this recording, your dividends, even before the end of this year, your total dividends received will exceed your initial investment. And so what happens there is your risk has gone down, right? The risk initially back in 2010 was the amount of money you invested, $9,585. If the company went bankrupt, you would lose all of it. But now, every time the company paid a dividend, your risk went down. And they paid a dividend, and the risk went down. And like I said, as of this recording, before the end of this year, the dividends, total dividends received, will exceed your initial investment. And at that point, your risk with this investment is zero because you've already made your money back. And then it's just pure profit. And as we're showing you on the screen, hopefully the dividend will go up again, but let's just stick with the numbers we have on the screen. You're looking at over a 10% return every single year in dividends. So that is the power of holding on to your shares and holding them on for the rising dividend, because your dividend yield will grow over time and you'll receive more dividends, more cash, and that's more money in your pocket. So, very important, I want to repeat this again, hold for the rising dividend because it's going to mean growing passive income for you. Now, this is all passive income. You made the investment in this example back in 2010, CIBC, and then you held on to the shares. You didn't have to buy more or sell them or track them. You didn't have to spend any time on holding on to these shares, but yet your dividend income kept going up every single year. So to me, that is growing passive income. Okay, let's get to our final and last topic in this episode. And now we're going to show you some real life examples where we've been able to double our investments. So we're going to look at 4 Canadian companies. We have Canadian Natural Resources, we have Fortis, we have Bell, and we have CIBC. You can see up on the screen here the stock price for each of those companies back in 2012. And you can see the dividend back in 2012 for these 4 companies. So I'm not going to read them all out. I'll just read out Canadian Natural Resources as an example. So you can see the dividend back in 2012 was 42 cents a share. Stock price was $25.87. Now we take a look at the stock price today for those 4 companies, and we look at the dividend today for those 4 companies. So the dividend today for Canadian Natural Resources is $3.40. And remember, back in 2012, it was 42 cents. Fortis, dividend today is $2.26. Back then was $1.20. Bell Canada, the dividend today is $3.68. Back in 2012, it was $2.22. CIBC, dividend today is $3.40. Back then was $2.31. Now, if we put all this together, you can see the total return, including dividends. So we're adding capital appreciation plus dividend income, and we're factoring in dividend growth since 2012. You can see that Canadian Natural Resources has returned over 235%. That's more than double your initial investment. Fortis has returned over 127%, again, more than double. Bell Canada has returned over 137%, and CIBC has returned over 139%. So that was the promise I made to you at the beginning of this video, to show you how you could double or more than double your investment with dividend stocks. And you can see that now on the screen in front of you with these 4 companies. Now, even more important than these numbers is the dividend yield. Dividend yield based on the original purchase price. So you can see Canadian Natural Resources, the dividend today is $3.40. We're going to divide that by the stock price back in 2012 when you would have bought it. And the stock price back then was $25.87. So if you take the current dividend divided by the purchase price, and we express it as a percentage, you can see that it's over 13%. So Canadian Natural Resources is now giving you over 13% return every single year for as long as you own those shares and as long as the dividend is paid. Fortis is going to be over 7%. Bell Canada is over 9%. CIBC is over 9%. Again, these numbers are very good. This is going to allow you to beat inflation. And these numbers are higher than what you can get in a bond, in a term deposit, or in a bank account. So that is very good returns while you hold on to your shares. So we've shown that it's possible to double your money with dividend stocks, and even more than double, but it does take time. So you need patience and discipline. So you need the patience to hold on to the shares and not sell them. Hold on to the shares over a long period of time. Now, it's all relative. In this example, we started at 2012. So we're going back 10 years. For some people, 10 years is a very long time. For some people, it's not. Nevertheless, you need patience because we are long-term investors, right? We don't buy and sell stocks every week or every day. We are long-term investors. We hold. So you got to have the patience to hold. Then you have to have the discipline to stick to this approach. So even when the market crashes or the market goes up, when the market goes up, you don't want to get too greedy and pay a high price for stocks. And when the market crashes, you don't want to panic and sell everything. So you got to have the discipline to stick with this strategy. So now, does this mean that you should go out and buy any stock that pays a dividend? And the answer is no. What you want to do is you want to invest in quality dividend stocks, not just any stock, quality dividend stocks when they are priced low or undervalued. So how do you know when you're looking at a company today? How do you know when you're looking at a company if it's a quality company and if it's undervalued? So for that, I've created what I call the 12 rules of simply investing. So if you're watching this, you can see the 12 rules up on the screen. If you're listening to the podcast, I will read out the 12 rules just in a second here. But these 12 rules, think of it as a checklist. Before you invest in any company, you want to make sure that it passes all of these 12 rules. Not just 9 out of the 12 or 8 out of the 12, all of the 12 rules. If a company fails even one rule, skip it. Move on to something else. These rules are designed to minimize your risk, maximize your returns, and help you build a resilient stock portfolio that's not going to be affected too much when there's a market crash or stock prices go down. Okay, so now let's take a look at the 12 rules. Rule number 1, do you understand how the company is making money? If you don't, skip it, move on to something else. Rule number 2, 20 years from now, will people still be using its product and services? Right? You're investing your hard-earned money. You want to make sure that company that you're investing in is going to still be around 10, 20, 30, 40, 50 years from now. Rule number 3, does the company have a low-cost competitive advantage? And we talked about that in this episode with the example of Coca-Cola. Rule number 4, is the company recession-proof? Rule number 5, is it profitable? Rule number 6, does the company grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid companies with recent dividend cuts. And we saw that with COVID in 2020. A number of companies cut their dividends. Rule number 10, does the company buy back its own shares? Rule number 11, is the stock priced low? Remember, we want to look at companies that are undervalued. So in rule number 11, we're looking at the PE ratio, making sure it's low. We're looking at the price to book ratio as well, making sure it's low. And then we're also comparing the current dividend yield to its average dividend yield. If you want more information on that, we have an entire episode. Episode 1 talks about how to figure out if a company is undervalued or overvalued. So go take a look at episode number 1 if you're interested. Rule number 12, keep your emotions out of investing. Okay, so there you have it. Those are the 12 rules. For those of you that are interested in learning more, I have the Simply Investing course. It's an online course. It takes you through all of the 12 rules in detail with real life examples. And I also provide you with spreadsheets. So you can take these 12 rules and apply it to any stock anywhere in the world and figure out if a company is a quality company and if it's undervalued. Okay, so if anybody's interested, the Simply Investing course does that. Another option, if you want to go a little faster, with the Simply Investing platform, this is a web application which is available on a subscription basis. Inside the web app, what we do is we track over 6,000 companies in the US and Canada, and we apply the rules, Simply Investing rules, to all of those companies every single day. So you can log in right away, immediately, and see which companies are quality companies, which ones are not, which ones are undervalued, and which ones are overvalued. So you can quickly make a decision on what to focus on and what to avoid. So for those of you listening to this podcast today, I want to offer you this coupon code, SAVE10, SAVE10. This coupon code is going to allow you to save 10% off of all of our products and services. You can get 10% off the course, which is a one-time fee. With the platform, you can get 10% off every renewal. So if you're month to month, you'll get 10% off every month. If you're on the annual program, you'll get 10% off every single year, as long as you remain an active subscriber. I hope you enjoyed today's episode. If you like the episode, click on the subscribe button. That way you'll get a new episode every week. We do have episodes out every week. If you subscribe to it, you'll get notified that when the new episode comes out. If you like the episode, be sure to hit the like button. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.